Hi guys, this is Sia Jain and welcome back to my channel ACCA and beyond. So I'm very sorry for the previous recording and or lecture attending abruptly because I meant to click the pause button but I clicked stop button by mistake. So I'm going to start with test understanding 6 and this I'll just read out the sum. So Wilson received an 18 million 5% loan on 1st January 2018 to finance construction on a new factory. As the funds are not all required immediately, Wilson invested 6 million in 2% bonds until 31st May. Construction of the factory began on 1st March 2018 and was completed on 31st December 2018. Calculate the amount of interest to be capitalized in respect of the factory as at 31st December 2018. So this sum is very simple, it's very easy, and it covers majorly all of the concepts which are in borrowing cost. So yeah, let's solve this sum. So over here I can see we have taken out a loan on 1st January 2018, but we only began contributing towards the construction on 1st March. So according to IAS 23, activities that are necessary to prepare the asset for its intended use or sale are in progress, and over here obviously we're not doing anything to make our asset. So for these 2 months, Jan and Feb, I'm not going to be calculating any I'm not going to be capitalizing any interest cost. Obviously I will have to pay interest, but I'm not going to capitalize it. For these 2 months, all our interest are going to be going to in a profit and loss statement. We are not going to be capitalizing it in a financial statement, statement of financial position. So for I'm going to be calculating it for the rest of the 10 months. 1 second. So I'm, for calculation purposes, I'm going to be taking 18 million as 18,000, and it is for 5%, which is for 10 of 12 months. So it's very easy, the calculation part at least. The 5% we have 900, sorry, and we are going to be using it for 10 months, which gives us 750 as our interest which needs to be capitalized. But now over here 6 million was not required immediately, so we invested it. And according to IAS 23, if any money we have taken out as a loan, and if we do not need it immediately and we invested somewhere, then we have to subtract the earnings from this investment from our capitalization. So over here I'm going to be taking 6 million as 6,000, which gives us 2% of an interest. But over here again we have it till 31st May, which gives us 5 months of investment. But over here we were not contributing anything for Jan and Feb, right? So we are not going to calculate it for Jan and Feb, and we are just going to be calculating it for 3 months, which again gives us 6,000 for 2% for sorry, how much month was it again? Yeah, 3 months. 3 upon 12, which gives us 30 as our earnings, which we are going to directly minus it from our interest charge, which gives us 720 as our answer, which needs to be capitalized. Over here the interest cost which we are going to pay for 18 million loan for Jan and Feb, because we are not making any active contribution, needs to go into a profit and loss statement. And the earnings we did for 2 months over here in our investment also on Jan and Feb needs to go into a profit and loss statement. So this was an fairly easy sum. Let's move ahead. Where funds for the projects are taken from general borrowings, the weighted average cost of general borrowings is taken. Let's see. If an entity has a 10 million 6% loan and a 2 million 8% loan, the weighted average cost of borrowing would be 10. Okay. So many a times you take two different loans to fund one project. So let's say if an entity has borrowed a 10 million on 6% and 2 million on 8%. So how do we calculate the weighted average cost of borrowing? It's very simple. You just take 10 million into 6%, which is given in a sum, 2 million into 8%, which will again be given in a sum, and we add 10 plus 2, which gives us a denominator of 12 million, and whatever we get is our answer. I'll just show you how to do this on the calculator so it doesn't confuse you guys. So let's take 10 million as 10,000, which gives us into 6%, which gives us 600, and 2 million, 2 million will be 2,000, I guess. Yeah, into 8%, which gives us 160. So 600 plus 160 divided by 12,000%, which gives us 6.33%. This is the weighted average cost of borrowing we'll take to solve the sums. Now, when do we cease capitalization? Capitalization of borrowing costs should cease when either substantially all the activities necessary to prepare the qualifying asset for its intended use of sale are complete, or construction is suspended, example due to industrial disputes. When you have completed building the asset, like it's complete, your let's say your building is ready, you have painted, you have done everything. Now if only finishing touches are remaining, you have to stop capitalizing your interest. Not just for finishing touches, you cannot keep capitalizing it. Maybe you have completed the building but you are not selling any apartments, you have no buyers, then also you cannot capitalize your interest cost. You have to cease capitalization. We do not care what you're doing with the property. If it's built, it's done, you have to cease capitalization. And if construction is suspended, so many times there are property disputes, there's so many legal cases going on, and because of that you have to stop your manufacturing or your construction, then you have to cease the capitalization of your interest again. So 1 second. So for this sum, I'm not going to be solving the whole. I'm not going to be solving this sum, but I'll explain it to you guys to how to solve it. And if you have any doubt, feel free to comment down. I'll solve this video for solve this sum for you guys. So on 1st January 2015, Sanisco began to construct a supermarket which had an estimated value of 40 years. It purchased the site for 25 million. The construction of the building cost 9 million, and the fixtures and fitting cost 6 million. The construction of the supermarket was completed on 30th September 2015, and it was brought into use on 1st January 2016. San Francisco borrowed 40 million on 1st January 2015 in order to finance this project. The loan carried interest of 10% and it was repaid back on 30 June 2016. Calculated total amount to be included at cost in property, plant and equipment in respect of the development at 31st December. Yeah, so the sum is very simple. We just have to calculate the property, plant, and equipment cost, which we are going to be including in our statement of financial position. So this is very simple. First, we'll take the obvious cost. We'll obviously include the 25 million for our purchase of the site. Construction also we'll take 9 million. I'll just confirm it in the solution. Yeah, 9 million. And then we have the fixture and fittings 6 million. Now the construction of the supermarket was completed on 30th September. After this, I need no information. If the construction was completed on 31st September, I am going to be calculating my uh what do we say, interest. Yeah, my capitalization of interest will be only be calculated till 30th September. So for 40 million on 10% per annum, I am going to be calculating interest only for 9 months. Yeah, so that's it. That's how you solve this sum. We are going to calculate our interest for 9 months, which we need to be including in our cost of our asset, and that's how we get the interest cost. So let's move on to IAS for the investment property. This part even I feel it's a bit tricky for me too, so let's focus on this part. So first we'll read the definition. So IAS 40 states that investment property is land or building held to earn rentals or for capital appreciation or both, rather than for use by the entity or for the sale on the ordinary course of the business. So we do not use the investment property which we buy is not for a daily use. We buy it only for a specific reason to earn money on it. Maybe you can rent it out to others, or maybe some it's an investment property, so maybe you buy a plot somewhere, today's value is 40 lakh, but there's investment opportunity over here. Maybe there's a metro project coming nearby, and for which it's guaranteed that the price of that land is going to increase. So maybe for that purpose you have bought that land to to earn money on it, because after the metro project comes, you can just sell it for a profit. So it was a rather long example, but so when you buy such assets only for the view of earning profit on that asset, we call it as investment property. Owner occupied property is excluded from the definition of investment property. Maybe you bought a building thinking that this building has potential, but if you're using it for your office use or your administrative use, then you cannot include it as investment property. These could be separate properties rented out to third parties or specifically bought in order to profit from a gain in value. So yeah, you can rent it out, or you just bought it for a or in order to profit from it. There could be situation where the building can be accounted for in two different ways. If an entity occupies a premises but rents out certain floors to other companies, then the part occupied will be classed as property, plant and equipment, per IAS 16, with the floors rented are classified as investment property per IAS 40. So if you have a long building, let's say it has 10 floors, and the first 5 floors you're using for your own personal office use, and the top 5 floors you have rented it out to others, so you can account for this first 5 floors under IAS 16, which was property, plant and equipment, and this 5 floors you can account it as under IAS 41, which is investment property. Now let's talk about consolidated accounts. If an entity owns a building that is rented by a subsidiary of the entity, then the building will be classed as investment property in the individual entity financial statements, but will be classed as property, plant and equipment per IAS 16 in the consolidated financial statements. This is because the asset will be used by the group, so must be accounted for in accordance with IAS 16. Again, so if you have a building and this is being used by a subsidiary company, so in my books, in the company, the group's book, in the main head's book, I'll account it for IAS 41, because of course I've rented it out to a subsidiary. But when we make group accounts, which we are going to study later how group accounts are prepared. So if I'm making one whole financial statement for the whole company, like me, my subsidiaries, my associates, everyone is included in that group account. So in that group account book, I'm going to be classify this as IAS 16. Okay, this is because the asset will be used. This is because the asset is being used by the member of the group. The member of the group is using it as an office or for administrative purpose, so we are going to account it for IAS 16. Now the accounting treatment. How long is it? Okay. Investment property should initially be measured at cost. So first we always recognize it at cost. Then we have two subsequent measurement choice, which is the cost model and the fair value model. Cost model is rather easy. Actually, both models are easy. Let's study them. Once the model is chosen, it must be used for all investment properties. Okay, this is important. You can't just choose cost model for one building and then fair value model for another building or another property. You need to choose one model and use it for all of your properties. Now, under cost model, the asset should be accounted for in line with the cost model laid out in IAS 16. So this is very simple. You recognize, let's say you have an asset worth 1 lakh, you recognize it as 1 lakh in your cost statements, and then depreciate it according to its useful life. So this is very easy method. Now we'll study the fair value model. Under the fair value model, the asset is revalued to fair value at the end of each year. The gain or loss is shown directly in the statement of profit or loss, not other comprehensive income, and no depreciation is charged on this asset. Fair value is normally established by reference to current prices on active market for properties in the same location and condition. So in the fair value model, let's say we bought the property for 1 lakh, but at the end of the year we find out that the property is worth more right now. It's 1,20,000. So this 20,000 gain, we are going to take it to our profit and loss, not other comprehensive income, and we'll recognize 20,000 on profit and loss, and in the statement of financial position we are going to recognize our asset as 1,20,000. Again, we'll not charge depreciation, because again at the year end we'll find out the fair value of the property and we'll balance it out. Okay, let's do the sum. So in test your understanding 8, Celine, a manufacturing entity, purchased a property for 1 million on 1st January 2011 for its investment potential. So it's investment property, not PPE. The land element of the cost is believed to be 4 lakh, and the building's element is expected to have a useful life of 50 years. At 31st December, the local property indices suggest that the fair value of the property has risen to 1.1 million. So I'm going to open the solution for this sum. Okay, so and what do we have to do? We have to show how the property would be presented in the financial statement as at 31st December if Celine adopts the fair value cost model and the fair value model. We'll have to show both the models. So under the cost model, it's very easy. Let's say it's 1 million. So let's say it's for 1,000, and 4,000 is for our land part and 6,000 is for our building. Now, of course, it's common knowledge that land cannot be depreciated. So we are just going to depreciate our building, which is going to be 60,000 for 1 upon 50 years. So because we just have to find out depreciation for 1 year, which gives us 12,000. So in the statement of profit or loss, we are going to charge 12,000 as our depreciation and minus 1 lakh from our depreciation, minus 12,000 from our 1 lakh from a 10 lakh, sorry, which gives us 99 lakh 88,000 in our statement of financial position as a non-current asset. In the fair value model, what we'll do is we'll start directly from 1 million, we'll jump to 1.1 million in our statement of financial position, and that 0.1 million gain will be shown in our profit and loss. That's simple. Done. So if an asset is transferred from property, plant and equipment to investment property and the fair value model for investment property is used, the asset must first be revalued per IAS 16, creating a revaluation surplus in equity and then transferred into investment property fair value. So if we are switching from IAS 16 to IAS 41, like let's say we are using a building for office purposes now, but now we do not use, we are using it for investment purposes, then we switch it, and when we are switching we must first reevaluate according to IAS 16, and if we have any revaluation surplus, uh, if we are maybe we have some gain, we have to recognize it in a revaluation surplus which is in equity. If the cost model is being used for investment properties, the asset is transferred into investment properties at the current staying amount and it continues to be depreciated. So cost model is very easy, no jhanjat. If you are switching from IAS 16 to IAS 41, you just need to let it be. If let's say in IAS 16 cost model our property value was 80,000, then in 41 also our property value is going to be 80,000, no jhanjat mari. This over here, this was a fair value. Okay, if you are using IAS 16 according to fair value, then you need to remeasure it. We need to find out the fair value, then only we can go to IAS 41. Now if an asset is transferred from investment property to property, plant and equipment and the fair value method is used for this property, then we revalue the property first per IAS 40. Again, this is the same as above, and taking the gain and loss to the statement of profit or loss. Over here we took it to surplus in equity, and over here we took it to take it to profit and loss, and then transfer the property, plant and equipment at fair value. If the cost model is used for investment properties, the asset is the current carrying sorry, just let me drink some water. Okay, let's do test understanding line. Kyle co-purchased an investment property some year ago and carries it under fair value model. It's an investment property, so we have IAS 41. At 1st January 2011, the property had a fair value in Kyle's core financial statement as 12 million. On 1st July, Kyle decided to move into the property, plant and equipment and use it for his business. So from IAS 41, we are going to IAS 16. At this date, the asset had a fair value of 14 million and a remaining useful life of 14 years. What amount should be recorded in Kyle's statement of profit or loss for the year ended 2011? So, this is a rather easy sum. So, from it's very simple. Over here only we have read if we are revaluing it from IS 40. Oh, this is IS 40. Sorry, I have been stating it as IS 41. Then we revalue it before switching to IS 16. We need to. 1 second, someone's on the door.